Hello, welcome to LCG's look ahead to the key events in markets for the week starting December the 19th, 2016. Now, the Federal Reserve finally did it last week and lifted the benchmark US interest rate by 25 basis points for the first time in 2016. That was to a new range of 0.5 to 0.75%. The repercussions of higher rates in the US are still being digested in markets. The rally in the US dollar and US Treasury yields, as well as the sharp decline in gold, are especially in focus. This week is the turn of the Bank of Japan to set monetary policy at their meeting early Tuesday morning, in what will be the final important central bank decision of 2016. Now, later on in the week, we will get the final figures for UK and US GDP growth in the third quarter. The week is the last hurrah for the corporate earnings calendar before the holidays as well. We've got Blackberry, Nike and FedEx, all of which are reporting third quarter results. Held by higher interest rates in the US and tapering of QE in the Eurozone, the Bank of Japan's policy shift towards targeting the yield curve is proving quite successful. The Bank of Japan wants to keep short-term interest rates low to encourage borrowing, but lift longer-term rates to ease the pressure on its banks and also lift inflation expectations. Keeping interest rates low in conjunction with its monthly bond purchases also serves the purpose of devaluing the Japanese yen. As a very export-orientated economy, Japanese companies benefit enormously from their products being more competitively priced overseas via a weak currency. Now, this can be seen in the positive correlation between Japan's benchmark stock index, the Nikkei, and dollar-yen. The lower yen also increases import prices, which the Bank of Japan is using to help reach its 2% inflation target. Now, again, helped by recent policy moves by the Federal Reserve and European Central Bank, the BOJ has for now overcome its credibility problem. The decision to cut its benchmark rate into negative territory in January this year was very badly received in markets and sent the yen flying higher. Now, since the policy reset has helped the Japanese yen fall to its lowest in 10 months against the dollar, and Japanese economic data has started to improve, the Bank of Japan is very unlikely to ease policy at its December meeting. The flash reading for Japanese manufacturing PMI for November rose to its highest in almost a year, in data released last week. If the yen is continuing to weaken, it will likely be because of more aggressive than expected tightening from the Fed and tapering from the ECB. Now, with all that said, let's have a look at the chart for the dollar-yen. As this daily candlestick chart shows, there has been a melt-up in the dollar versus the yen. The trend is clearly higher with no sign of a top, but a large pullback is well overdue. Possible resistance lies near current levels near 118, then 120, with support near 116, then 114.80. The US and UK report the final version of third quarter growth statistics on the Thursday and Friday, respectively. Now, expectations for the US are 3.3%, up from 3.2% year-on-year in the previous revision. The pickup in growth in the last part of the year has played into the expectation that the Fed will be in a better position to tighten policy next year. There is a little deja vu here, though, at the same time. Growth peaked in the third quarter of 2015 and was soggy thereafter. The result was the Fed's forecast of 4 rate hikes in 2016 going sour, with only actually seeing 1. If Trump's fiscal stimulus doesn't take off, this could be as good as US growth gets. However, if it does take off, then Trump's promise of 4% GDP growth could actually become reality. Now, the upshot is that Trumponomics adds even more uncertainty to the US growth outlook. Expectations for the UK are 0.5% quarter-on-quarter unchanged from the previous reading, making the annual growth rate 2.3% year-on-year. Now, it's a slight slowdown from the second quarter, but still makes the UK one of the fastest growing countries in the developing world. The British economy has proved very resilient to any Brexit uncertainty. With the benefit of hindsight, that makes sense because nothing has actually changed as of yet. As far as the meaning of this GDP data, GDP is backwards looking. Now, markets are interested in the future and the possible negatives of higher inflation on consumer spending and businesses withholding capital expenditure while the UK negotiates its exit from the EU could all mean future growth is little more than sluggish. Let's have a quick look now at the chart for pound dollar. The cable rate has broken the rising blue trend line and is making lower highs and lower lows, characteristic of a downtrend. There is a confluence of potential support near 1.23 to 1.235 from the November 17 swing low and the 61.8% Fibonacci retracement of the up move since October 24th. Now, the broken trend line could offer resistance on any bounce. On the company earnings front, the most interesting results are to be found across the pond in the US. Blackberry reports its first set of results since ditching its handset businesses on Tuesday, December the 20th. On the same day, FedEx reports results ahead of its most important quarter of the year, Christmas. Nike shares have been the worst performer in the Dow Jones for 2016. It rounds off the week with its third quarter earnings on Thursday, December the 22nd. Now that's it, the final week ahead for 2016, hence the Christmas jumper. But have a lovely Christmas, Happy New Year, and see you in 2017.